We're on. Welcome, everyone. Today, welcome to In the Charts. We're going to use, for the first time, the randomizer. So I'm going to actually present my screen. And we're going to see who's going to go first. Look at that. Those are our faces. I'm going to press this button.
Drum roll,
Who's
please.
going to present the chart?
This is what Diogo's doing on weekends.
I am vibe coding. There you go, Breck, Diogo, and Chris.
Let's go.
Breck, you go first.
Let's do it.
Start with this one. So I have a lot of charts today. I'm kind of cheating.
You're cheating again.
I am. So let me give a little bit of a preamble here. I was meeting with the founder in San Francisco a couple of weeks ago, and he asked me, what apps for crypto do I use as a daily active? And I was a little embarrassed for my answer because it was CoinMarketCap. Like CoinMarketCap and Dex Screener and Crypto Twitter. And that's like a pretty crappy answer, but I think it's also an answer that a lot of people would give. And I didn't like it. And I started to ask myself, like, why do I not use more crypto apps? And I think there's a couple of reasons. Back at Zora, we had launched a couple of mobile applications, but the App Store always made it tricky. I think for a while, NFTs were actually banned from the App Store. And then, of course, they've had the 30% rake for in-app purchases for the longest time. There was some news last week from the Epic and Apple lawsuit that actually reversed that. And now there's going to be a pathway for you to circumvent the 30% in-app purchase rake. So maybe there will be a time for a change. But I went down this rabbit hole basically of why aren't there more mobile applications that people use on a regular basis? And so I wanted to just pull up some data to see what what greatness looks like. What do the big apps commandeer or command for usage on a monthly basis, and then compare them to some of the apps that are more crypto native. So we'll start here with Coinbase. It's not exactly apples to apples to mobile active users, but it's active. And you can see in Q4 of 2024, they're at around 8 million monthly actives. And then let me pull up another. Okay, so now we've got Robinhood up here. This is actually what greatness looks like, I suppose. So they're much higher. They're actually in the 15 million monthly active range. And then if we go to, everyone I'm sure has heard about Phantom. They're a private company, so it's harder to get their stats. But they claim in 2024, they got up to 10 million monthly actives. I'm going to use this chart from Artemis that shows Jupiter, which is the primary aggregator for trading meme coins on Solana, almost as like a proxy for Phantom. Because Phantom, I think, is the primary way that people access Jupiter, especially through the mobile phone. Jupiter also has an app, but I couldn't get their metrics. So we're looking at single digit, double digit millions as that's what greatness looks like for some of the most used apps in crypto. But then we look at things like Pumped Out Fun and Polymarket, and I think we'll get slightly different numbers. So let's do Pump here. This is another chart from the guys at Artemis. Peak in January, they got up to above 4 million, but they've been pretty down since. So the usage is not as sticky as maybe we've seen from a Coinbase or a Robinhood. And then probably the most well-known app outside of crypto this last cycle was Polymarket. And they're far lower than even Pump That Fund. They're in the hundreds of Ks. And I don't know, I wanted to have a little bit of a conversation about why are there not more applications in crypto that people are using on a daily, weekly, monthly basis? And how do we fix some of these issues? I think the Apple and Epic the resolution of that lawsuit maybe will provide a tailwind for people to want to go mobile first for launching more apps. But I'm curious to get your all's thoughts.
Yeah, I mean, look, the obvious answer is the use cases that have succeeded in crypto are not use cases that turn you into a DAO. I mean, literally, the space was built with HODL and buy and never sell. That is definitionally something that you interact with once, unless you obviously like consider checking the price as an activity, in which case maybe there's many daily active users. And then recently we have seen product market fit. I would say that a lot of the daily active users in crypto are DeFi users or traders or people kind of like doing active things. And the most recent product market fit is RWAs and stables. And for stables, actually, the interesting thing is that it merges, right? Now you have to just look at a fintech app that in South America or in Africa, and you have to sort of merge to see how many daily active users are actually using the dollars, because technically they actually count towards crypto or should count towards crypto. So that's the other thing that I would say is like, I think you're right. There's not that many daily active users for the prior product market fit, but for the current product market fit and the things that are growing, I don't think you're going to see it in the charts, or at least you're going to have to look at the charts of traditional fintechs.
Yeah, I'm going to pile on to that. I think there's a couple things that pop to mind. The first is actually linking back to Diogo's chart from last week. More investing is actually becoming passive over time. So if the use cases remain, the use cases today are speculation, and then the early use cases today are some form of payments, and then probably to come after that is going to be some type of savings or investment. And so even the use cases that are kind of early and seem like they're going to come and are right around the corner, the trend is actually becoming more and more passive, which doesn't bode well for spawning more DAUs in crypto. The other observation here is that when we think about DAUs for internet companies, I think the business model actually aligns towards fostering more DAUs, which is the business model of ads. For ads, part of the reason why I think DAU started becoming like the metric to track for a lot of internet companies was because when we thought of a very successful large internet company, I think we started to think of social applications, and the way that social applications made money was by monetizing eyeballs through ads. And so I think we've also been kind of trained to think about DAUs as the metric, the North Star metric to really go after. But as far as the use cases go in crypto, they haven't really been aligned to that business model anyway. I do think, though, that if crypto were to start to hatch out of financial use cases and start to become more of a consumer use case, we do need to pay attention to time spent in app. And that's the other metric that obviously those are not really reported, but I would say even as an MAU, time spent in app is probably very low. Right? You probably check it once and then, you're not really interacting with much.
Yeah, I was thinking as well about Diogo's chart. Like, what was it again? It was like 80% active to like sub 20% active.
That's right.
So that resonates, but it doesn't explain, like, Coinbase and Robinhood both have, healthy MAU numbers in the millions, high single digit and then mid double digit. But then you look at Polymarket, that's in the hundreds of K. And I can't help but think like mobile is a big reason for why someone's going to come back to. It's just more accessible to be able to log in, open an app on a phone, toggle screens, receive notifications, and there's just not that much mobile penetration. If you look at the top three, Phantom, Coinbase, Robinhood, they all have great mobile apps. The other thing that I was thinking about, I think, is an orientation around a user versus an orientation around trading volume or TVL. I think oftentimes the metrics that we use in crypto to define success are at an aggregate asset level, and they're not about a user. And I think that means that the product just doesn't get sticky over time because you're not building for a user in mind. And I'm hopeful that if mobile becomes more of a path for crypto application developers to be able to distribute their products, that it will be more product centric, it will be more user centric, and the tail won't wag the dog, so to speak. So
It would be interesting.
that's
It
my
would be interesting in
request.
the future to compare Polymarket, not with crypto activity generally, and compare it with either Kalshi or at the higher end actual gambling apps. And recognizing,
Totally.
by the way, that maybe the expectation that something like Polymarket is very high on DAOs is the wrong one, because the reality is that people gamble around big events. And so that's unlikely to actually like map perfectly. The use case is gambling around big events and betting on big events like the presidency of the United States or gaming or games or whatever. So maybe the
That's right.
pattern there for actually
And
gambling
remember,
is different.
for Polymarket, their mobile app didn't allow you to actually trade. So it was only a way for you to read the markets. And so I think that's where the Apple Epic thing comes in. Like, hopefully it'll be less of a nerfed application experience and something that like people can actually interact with on a daily basis. All right, who wants to go next? I don't
Well,
remember
I'm
who
next.
the randomizer
You saw the
says.
randomizer.
Diogo. I
Yes.
can remember.
Okay, so I'm bringing you an interesting one today. I am bringing you quantum risk calculator. So the context for this is pretty obvious, but essentially there's been lots of conversation around quantum computers and the progress of quantum computers. A reminder, quantum computers the existence of quantum computers allow you to break classical encryption. So there's algorithms like RSA and the CDSA, in which obviously blockchains are dependent on, that depend on factoring or discrete log problems remaining hard. And quantum computers basically break that assumption. There's something called Schroer's algorithm that allows you to actually break and from a public key derive the private key. So something that should never happen, of course. So I bring you 3 charts, not one. I'm also cheating, but mine at least are all on the same website. So the first chart that I want to show you is the number of qubits over time. And there's actually lots, not all qubits are the same, but first I want to show you that there's lots of data points. There's been lots of progress over time, and we're actually sitting now in 2025 with thousands of qubits on these quantum computers that actually are starting to get to the point where, from just a qubit number perspective, this actually starts becoming of the realm of possibility. So, of course, qubits and the number of qubits, quantity is not all that is necessary. You also need quality. So the second chart that I want to show you is that not just the number of qubits is growing pretty massively. This is a log chart. Also, the gate infidelity, or the reverse of this, which is gate fidelity, is actually decreasing quite significantly. And in fact, this is actually a place where it's actually fascinating. So not only on the reliable qubit side, Microsoft announced in February this year, Majorana, which is a chip that they aim to have 1 million reliable qubits. And simultaneously, late last year in December, Google announced Willow, which is only 100 qubits, but they claim to have achieved exponential error suppression. So again, like number of qubits, Microsoft pushing for it on chip, and Google pushing for gate fidelity very high, because you actually, if you have exponential error suppression, that's actually a major game changer here. And so these two things, one is up and to the right and the other one is down and to the right, as it should. And then finally, the time to break signature schemes is reducing quite significantly. What this quantum calculator does is takes these data points and tries to estimate when actually these things may happen and when the intersection of the graphs may actually exist. And what this actually says overall, and there's lots of debate, these things are not known, but at the low end, we may have a quantum computer that actually can factor in real time private keys in 2027 at the earliest, and then in 2035 at the latest. Those are kind of like, it's a pretty big range, but it's kind of the range that is being talked about. So now, of course, how does that relate to this conversation? And look, I'll be the first one to say that worrying about quantum computers and just talking about crypto is kind of silly. I mean, what kind of cryptography do people think that nuclear launch codes use, right? So nuclear launch codes also use classical cryptography. So you should be worried about more important things here. Like the whole internet breaks if a quantum computer that actually allows you to factor these things in real time. But still,
Quantum
we care
doomer.
about Bitcoin. Quantum doomer. So obviously there's an attack window and taking Bitcoin, which is obviously the highest market cap cryptocurrency. The estimates are that 25 to 35% of them actually may be at risk of being factored. And so even though we're not, in Q day yet, quantum day, there's definitely the need to start thinking about this. And the community has already been obviously doing stuff. That NIST itself already has new lattice-based cryptography standards. There's Kyber, there's the Lithium, they're ready. And even Bitcoin developers have already been discussing soft forks for quantum safe addresses. using Schnorr and Lamport, Falcon, and they're trying to basically move coins earlier so there's no rush to move them later. But it's still something that is actually becoming concerning. So the summary is like, look, I think we're accelerating really fast, faster than people would have thought 2 decades ago. And Bitcoin is definitely not doomed tomorrow, and neither are other blockchains. But this is something we need to concern about and start thinking about how do we actually move forward. And in fact, you guys know, I've already seen lots of pitches of either quantum resistant layer ones or things that help migrate Bitcoin to quantum resistance. But when these three curves start to intersect, that's our fire alarm that things may not go well for these old technologies. So I'm going to stop sharing it. What do you guys think?
I have a really dumb question because I'm not a cryptographer, and I wanna lean on a mental framework for thinking about how to actually interpret these charts, because I feel like you talk to one person, they're like, don't worry about quantum. You talk to another person, they're like, oh my god, quantum is going to kill everyone, or whatever it may be, the doomer spectrum. And I think the mental model that we're used to is Moore's law, right? um Compute gets cheaper, roughly 2x a year, or 2x every 2 years, whatever it is. Um, what you just showed us in the qubit chart is something different. We went from 100 qubits to, I think, 3,000 qubits in like a year. So that's not Moore's law. And how do you reason through like the shape of the curve? Because it doesn't feel like there's too much consistency, and it's something that I wanna understand a little bit better before prescribing judgment.
Yeah, so the question is around rate of progress. Like, how do you actually look at rate of progress? Look, I don't know if it's like doubling every 18 months or so, but there's clearly some exponential at work. And you don't know what the actual exponent actually is, but there's some exponent at work. And so I think the mental model still applies, regardless of the fact that we actually don't know how fast it is. And there's clearly jumps that are pretty big. I think it's easier for Moore's law because it's like a very measurable one-dimensional thing. Here, you're actually trying to tackle multiple things. And the reality is that, once you push the number of qubits, you probably like somehow increase errors. And once you try to actually get error correction to 5 nines, which is what we've achieved in 2025, then you're probably like reducing the number of qubits. Part of the reason why the Google computer only has 100 qubits, 105. And so these are multidimensional things. So I don't think, progress is I was going to say a straight line. Clearly, none of these things are straight lines, but I don't think you can kind of sort of apply that same mental model. And I agree with you. It's kind of people that we respect deeply say don't worry about it, and people that we respect deeply say care about it deeply as of today. And it may actually already exist. So
it kind of reminds me of the, like, you remember in 2014 everyone was like, autonomous vehicles are 2 years away, and then it was like, okay, it's 2016, autonomous vehicles are 2 years away, and then it continued until now we actually have Waymos in San Francisco. And I'm trying to understand, like, how scared should I be, and like how reasonable are these charts?
I think it's also interesting to think about this from a game theory perspective, because this is one of the classic potential scenarios where you could have tragedy of the commons, where it's like everybody's problem and therefore it's nobody's problem. And especially for something like Bitcoin, the biggest problem is for Satoshi, who like has the most coins, right? Who nobody knows where that person is. And so I think it's interesting to think about, if there's an imminent threat of quantum looming, is it better for you to be an incumbent chain, or is it better for you to be a net new chain? And I think so far, a lot of the projects that we have seen are around the protection of existing chains. But it's not clear to me that you could get everybody aligned and organized in such a fashion in a timely manner. And if you do, the implementation paths on how you actually protect yourself from quantum are all going to be so different, right? You could have something as simple as changing signature schemes, but that has downstream impacts on block sizes and therefore the number of transactions that can fit in a block. And so there's a lot of downstream implications of this, and actually like fixing it for quantum or making it quantum safe is a really, really deep rooted problem. And it's not clear how existing chains are going to really be able to handle that.
particularly hard to see something like Bitcoin move fast, right? Especially something that there's so many issues. The last major change took so long, and there's so many issues. This is much bigger, as you were saying. The proof sizes are humongous. It would increase probably by 10x or 20x the amount of actually historical blockchain size, and it would probably like slow down the network quite dramatically. So, I mean, you'll solve these problems, and there'll be a way forward. But there's so many different potential possibilities that then the debate is unending, and it will never end, and it will never actually converge. And so Bitcoin is not great with multiple choices. And by the way, Breck, there is something called Rose's Law, which is basically, I think, the number of qubits doubles every 18 months or so. But it was coined by an investor. It was coined by an investor, so nobody cares about it.
Oh, that's hilarious. That is really funny.
Hilarious. Chris, you're up. Let's see what you've brought.
All right, let's go. It is stablecoin season because Stripe sessions happened in San Francisco this week. And let's see if this works. Can you guys see this? All right, perfect.
We can.
So I also brought 2 charts. So we're all cheating here. So we're all, playing fair game. But I innovated on UX because unlike Breck, I put this all in one preview.
Wow.
And so I don't have to go in and out of windows. So that's real innovation for you right there. But this chart is
Game
Apple Pay
recognized
sales.
game.
Yeah, man. It's the Kobe mentality, right? 1% improvement every time. So this chart is Apple Pay sales. On the y-axis, you have, this is all estimated value because I don't think they actually report it. But this is estimated value of Apple Pay in-store sales. So this is effectively the GMV or the payment volume of Apple Pay. And on the x-axis, you have the number of years. And so you can see the green line is the actual estimated sales value. And then the black line is adjusted for inflation, basically over the last 10 years. And even adjusted for inflation, you can see that Apple Pay in-store sales has grown by more than 4x over the last 4 years. So it was 46 billion in 2020. It is now over 200 billion in 2024.
You can
And
literally
I
see
think
the
this-
pandemic.
Yes, you can see how it's flat right here. And hence, in-store sales were not very popular in 2020. But it's grown tremendously since then. And I think this is important to point out because a lot of payment innovations end up being things that feel like 10% convenience innovations, right? So what's the true difference between carrying cash and paying with cash and paying with card? It's, hey, I don't have to carry around loads of cash and get change at the counter. It's marginally faster. But can you do something totally different? It's largely the same. And then the difference between carrying around an actual credit card or a debit card and using Apple Pay, it feels even thinner, right? Which is you're uploading your debit card onto a mobile app called Apple Pay. And then now you're just taking out your phone and paying instead of taking out your debit card from your wallet, which you might also carry around. And so even though this feels like a 5 to 10% convenience innovation, these things really compound meaningfully when you think about an average user's experience, and it allows something like Apple Pay to grow really, really fast. I think the other implication of this, though, is that the actual point of sale systems, a lot of them now feature tap to pay, right? So before, when you had to have a debit card or a credit card, it was a swipe mechanism or it was a chip in mechanism. And now with Apple Pay and the proliferation of tap to pay systems, you can truly just pay using your phone. And I think this is really important because when we think about enabling technologies, tap to pay and actually the innovation on the point of sale system is really important as we think about stablecoin adoption, stablecoin usage, and the actual usage of that, not just in online settings, but also in physical settings. The reality today is that, it's all still facilitated by card networks, which are the way that you get these things to be accepted by merchants. But the more actual physical hardware that you have for being able to accept actual mobile money, the more likely it is that you might be able to just have extremely stablecoin native networks be used for payments in the future too. So I'll pause here for this one, and then I'll show you guys the second chart after.
I actually think that Apple Pay might be more like almost like a 5x improvement versus a 5% improvement. Think about the number of people that are just walking around with their phone in their hand, and like they don't have to reach into their pocket anymore, pull out their, like that's like a 1 second sub-second like thing versus like a 4 or 5 second thing to ruffle into your purse, grab your wallet. And think about the amount of time that we spend on our phone, like the mental like I don't know, neuron firing to just like reach for your phone is way less than thinking about going for your wallet or where is it. And I think it's actually like a pretty big improvement to the user experience.
Don't
I
forget
would,
the
I,
people that are super cringe like me and pay with their watch. That's even
yeah, there you go. It sounds so simple, but I actually think it's like I never pay with my card unless I like, for some reason my phone's dead.
Breck is doxing me here. We talked about this yesterday.
Yeah, Chris, how often do you use Apple Pay, Chris?
There's also an overlay here, which is in the United States, we use swipes, right? And in Europe, we already use the MV. And so it's actually like there's a doubling up, like the convenience jumps quite dramatically because you can tap to pay. In Europe, has always been able to tap to pay. And that was always very convenient. And so for the phone, the experience is not that different. But for Americans, like the swipe in sign to actually just tap is pretty dramatically better. So I think you're seeing both things, right? The adoption of like people's prior mode was awful into something like a lot more convenient, and it's overlaid on the growth.
Yeah. I'll
Show us the next
move on
chart.
to the second chart. Yeah. So this one, wait, what?
Wow, Chris, I thought you had it figured out, huh?
I
Now you have to
Kobe
press
mentality,
down.
huh?
Have to press down or slide.
This is so disappointing.
Wow,
So
embarrassing.
Give me one sec.
Do 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 do. Can we like edit that into the video?
Probably.
Can we get Jeopardy going?
Yeah. Second chart coming up.
Here we go. So
Oh.
disappointing. I had that.
Wait,
all
we don't see
figured
it.
out, too.
We don't see it.
Yeah,
See it?
we don't see it.
There we go.
There we go.
That was very
We see it now.
disappointing. I'm sorry. I had it all figured out. Okay, so this chart is recent digital wallet usage by application, by year. So you've got Apple Pay, PayPal, Google Pay, Walmart Pay, Samsung Pay, and everything else. And the colors in the bar represent different years. So 2019, 2020, 2021, 2, 3, 4. The really surprising thing for me here is that, at least around me, I've never seen anybody else use anything other than Apple Pay. And what's really surprising is that PayPal has made this meteoric rise from 23 to 24 and is actually quite close in terms of usage to even Apple Pay. So, of the mobile wallets that they use in the last 7 days for in-store purchases, Apple Pay has a 9.4% share and PayPal has an 8% share as of 2024, which is really, really surprising to me, just given at least the experiences of people around me. And I bring this up because I still think what this means is that this market is up for grabs. And you would think that Apple, because it's vertically integrated and you can do the double tap and use Apple Pay, should be the clear and away winner, right? Especially when you think about it in the context of, oh, this is, maybe 5, 10, in the case of Breck, 5x improvements actually yield in large outcomes. I would think that the vertical integration with the double tap is going to be so much easier for somebody to use than, opening up a PayPal to actually start to pay for it. But I think I also bring this up because we're starting to see many neobanks using stablecoins pop up, or consumer financial applications using stablecoins pop up. And I think this market is still up for grabs. It's not the case that, Apple's just won this and it's a lost game.
So you have seen Google Pay and probably Samsung Pay. It's just a tap, so it's equivalent to Apple Pay, but on an Android, right? And so it's you would have to look at the phone and see what phone is. But it's just like all of them are storing like credit card credentials, so that's the actual rails that they're using. I believe same thing for Samsung Pay. So basically Apple Pay plus Google Pay plus Samsung Pay. I don't know about Walmart Pay, but those are all just cards and tokenization of cards, the old meaning of tokenization, in so neurotypical. I think it's kind of interesting to think through the stablecoin thing. And is there a way for Apple to run away with this actually and create a closed loop system or something like that allows them to use stablecoins? But the thing that it always comes back to is the thing that Visa has that is absolutely dominant is 90 million point of sale acceptance spots. And Apple needs to change that, right? So the merchant, somebody needs to do the business underwriting of like accepting the coffee shop, the merchant itself. Somebody needs to take that relationship and call into someone that does the payment. So Apple doesn't do that today, right? Apple does one side of it, tokenizes the card. Even if they want to have some way to communicate that is a closed loop system that bypasses the cards completely, then they need some merchant acquirer on the other side to kind of like accept that mechanism and then settle with the actual merchant's account with stablecoins. So that's actually the hard part, is how to get 90 million of these merchants and these points of sales to accept this closed loop Apple ecosystem.
Completely agree. Even outside of the frame of the conversation around Apple Pay, I think a lot of people are like, stablecoins are going to disrupt Visa and the card networks. And the reality is most people are using stables to off-ramp to their local payment network. It might not be Visa or MasterCard in developing countries where those are, or just our developed country where those are very prevalent. Like that ends up being, everyone wants to issue like a rain card or a bridge card to spend stables. But in places where there's not Visa network or MasterCard network penetration, you see it off-ramping to mobile money in Africa or e-cash systems in Asia. And so I do still think there is this like, stablecoins are not a silver bullet. You still have to meet people where they're at, and you have to do the hard work of getting the merchant acceptance like you brought up, Diogo. The two things that I was thinking about for this chart is, holy crap, Walmart is massive. I can't imagine that like you can do Walmart Pay in like a Costco, right? So like that shows you how big Walmart is. And the second thing is, where the heck is Venmo? Chris, we've talked about this a bunch in the office. Like Venmo was the first app that I ever used that was money on my phone. And man, did they swing and miss on the opportunity by keeping it to peer-to-peer payments and not trying to go into in-store and not trying to leverage the advantage to make phone commerce a thing. They really swung and a miss, and I can't help
But
but
Breck,
think
it could be that it's actually collapsed into the PayPal numbers actually.
Yeah. Venmo's owned by PayPal, so it could be in there, but I think PayPal is a combination of actually, it's not too different than Apple Pay, where you can upload a debit card or a credit card into your PayPal app, or people are using their PayPal balance. I don't know how well integrated the Venmo balance is into it, but it might be too.
Yeah, I've never paid with Venmo at a store.
Right.
I know you can, and we were looking at this a little bit. There is a PayPal app where you do all those things. So it has to, but it's still so weird. Like I don't know a single person who's ever done PayPal in store. I know like on eBay and like, you use the like PayPal widget online shopping, but never in store.
It is pretty cool.
This market's
But
up for grabs.
there's also not very many Walmarts in San Francisco, so I don't know anyone who's ever used a Walmart Pay.
All right, that's all I
Awesome.
got.
Thanks for bringing these charts, guys. We'll see you next week.
Yes.
With a 1x or 2x, sorry, UX improvement next time. Promise.
Let's go.
Oh man. All right. See y'all.
See ya.
Bye.